There's a lot of buzz around private markets and alternative investments, but very few people truly understand how they work, who they're for, or what's really happening behind the scenes. That's why I'm super excited for today's conversation with Kasper Wichmann, who has spent 2 decades in the engine room of global private equity, from building strategies at UBS to an Asian development bank to now founding his own company called Balentic, an AI-powered platform transforming how investors navigate private markets. He also shares razor sharp insights, which I love to read from his blog, PE Compass, which I really recommend them, and they will level up your understanding to the space. So, Casper, welcome. It's a privilege to have you here.
Thank you, Ahmad. Thanks for having me.
Of course. And before we dive into the world of AI and private markets, let's take a little step back. I'd love to understand why you started, or the why behind all this.
Behind entering private markets, so the
Yes.
whole journey,
Yes.
uh, I guess it was accidental. I left university well, just in the lead up to the financial crisis, I guess, '05. That's kind of where we went. We went into finance, or we went into consulting back then. Today, everybody goes into tech. And I ended up in leverage finance, so underwriting the very investments that a lot of the general partners make through their funds. I did that for 2 years and thoroughly enjoyed it, and then ended up in Switzerland working investment banking for Credit Suisse. Ran headfirst into the GFC, global financial crisis. Ended up switching to UBS, and that's where I became part of asset management and started investing into funds, which I have then done since around, I guess, late '07, sort of around the fall of Lehman. That's when I switched into the fund of funds business. Sort of fast forward, I spent a lot of time at UBS, ended up heading Asia Pacific for US asset management on the PE side, based out of Hong Kong. I had a stint at the Asian Development Bank, came back home to my home country, Copenhagen, where I joined a smaller asset manager, set up a fund of funds from scratch, and kind of realized, hey, look, this whole industry is just woefully analog, and the problems I thought that I had while working at UBS were just, magnitudes larger at a smaller asset manager. And so I thought, hey, look, if nobody else is doing it, maybe we should digitize private markets. And thus, that leads us to Valentic.
You say it very humbly that it was sort of accidental and kind of you're brought into private markets. But I'm sure you have a spark. What was that spark into the private equity instead of going like, okay, GFC happened, let's move into something else? Why did you stick with it?
It's an immensely interesting sector. It's constantly innovating. It's full of a lot of really smart people. So there's a lot of adrenaline. It's always interesting. It's always something changing. And so and in fairness also, there is a set of golden handcuffs when you work in finance. You're very well paid. There are large bonuses. So, it's leaving for something else. That's quite a leap of faith. So a lot of us just tend to stick around. But it's a very comfortable job, especially the more senior you get. Yes, we work hard, but it's very comfortable. And the job security sort of increases also with seniority. So, why you've got a good gig. Why leave?
People outside the industry, what do you wish they understood better about private equity? What are those biggest misconceptions you come across?
I think the biggest one is that a lot of people seem to still think that private equity is sort of inherently evil. It isn't. It's part of the financial markets. It's actually, it offers discipline. If a company is not well run, small or large, they can take it over and improve it. And I think by and large, a lot, if not the majority of all the PE deals or private market deals generally, they create value. They create jobs, they create taxes, they create rings in the water. And where you hear a lot about the mass layoffs, sure, that happens. But again, probably in the vast majority of cases, these are companies that probably had a lot of fat that could be trimmed. And a lot of really big companies do have a lot of fat that can be trimmed. So people don't fully understand. I think the industry, unfortunately, they haven't been as good as communicating about the benefits of private equity as they could be. And then, it's also sort of when you hear about all these big numbers, the bonuses, the carried interest, all the billionaires and so on and so forth, maybe you do also want to just keep a low profile and not, turn up on the front page of the FT or the Wall Street Journal.
That's funny. It does have a little bit of a stigma of being like private equity is going to take your job, or private equity is going to taking mom and pop shops and then firing everyone and doing it different. But it definitely is the other side of the coin. Actually, private equity don't do bad deals. They do good deals, and they find how to maximize value. And I think that's extremely honorable. How would you explain the private equity model to someone that has never worked in finance?
Oh, that's a brilliant question. You're catching me off guard now because I'm an insider. I'm not sure I can do that. It's a process of buying something. So a private transaction is that would be you and I walking down and buying the local deli. That's a private transaction. What we're then meant to do with it is we're meant to run it better. So you buy something, hopefully at a good price. When you bought it, we're meant to do something and improve it. So that could be more footfall in the shop. It could be maybe we can increase the prices, maybe we can do better service. So we increase the margins on our business and thus basically create more profit on the bottom line. And then ultimately, and that's the third part of what they do, we need to sell our deli again. And we need to sell it to somebody who wants to buy it from us and hopefully at a higher price, in which case we make money. And if we make money, when we then also make money for investors in case we had investors. So buy something, do something with it and sell it and hopefully do all three things quite well.
What makes it so powerful, and what are the trade-offs?
It attracts an awful lot of smart people and a lot of people who work very, very hard. So there's a lot of drive in there to do things with it. It's one of those things, people don't really go to bed. If there's something to be improved, it's improved because there's a lot of profit, there's a lot of potential, and there's also some very, very big paydays if you do well with the companies. And that goes from the most junior people involved to the very senior people. And that can be a very powerful motivator. And then I think there's also, it's not just the money. I think there's a lot of intrinsic motivation. Many of them are, if not all of them are, they're very smart people. They're very driven. They like what they do. They're analytical by nature. So being allowed to dig into this, it's a lot of fun. And that's a huge driver as well. I think if it's money alone, I think a lot of people would leave and some arguably do. Great questions.
I think that, it's private equity is the best business model in the world. It's the most lucrative. It's the one that produces the most amount of results. It attracts the best talent, like you were saying, but it is one of those that is fairly misunderstood. And I think an example is the LMVH group, that they are not designers. They are not, they are marketers. They're extremely good marketers, and they know how to position brands and put them in and elevate them. And so when you look at it in that way, and they've brought a lot more interest into private equity, what type of investors are now interested in participating? Why should someone say, hey, should I participate in this, or can I participate? Where do you come in?
I think most investors are already participating. If we have a pension scheme, we're probably invested. So when we talk about, and I don't like the name, but democratization, it's already been democratized. The ones in the US who are independent may not have that exposure if not part of an established pension fund, but by and large, most of the sort of Western world with large pension funds, we're all somehow exposed. So why be exposed? It offers some diversification compared to the more traditional asset classes. We're now in the alternative space. That's always a good idea. You don't want to be over diversified, but nonetheless, you also want to enter into private equity because you're tapping into deals that you won't find in public listed markets. So, there are many, many, many more private companies than there are publicly listed companies. I don't buy the argument of fewer publicly listed companies make the stock exchanges unattractive, but it's just the fact that sheer mass on the private side, there's a lot of profit to be made there, a lot of returns to be made there. So that's why people should move in some diversification, potentially some further upside, and then it all kind of makes sense.
If someone is listening and intrigued by private equity, but they don't know where to start, how should they begin to think about it?
Get a university degree. I think that's a prerequisite. It's really hard to break into this industry if you don't come with a degree, at a minimum, bachelor's. Unfortunately, but true, the more recognized university, the better it is for you. You move in typically through sort of an apprenticeship, if you like. You go through investment banking, you go to consultant. Here again, you want to try to target the blue chips because that is typically where a lot of them recruit from. I'm not saying it's impossible to come from elsewhere, but this is just you find a lot of people who've gone through the Ivy Leagues and then into the sort of branded name consultants or investment banks. The big four is another option. And then you find if you've got a PhD in healthcare and you want to work for a healthcare fund, that's obviously a good choice, right? You can go in that way. But once you've then done your 1, 3, 5 years, maybe a bit more, depending on whatever you want to enter at somewhere, then you start applying for jobs in private equity firms or private markets firms in general. Now you have some expertise, you've learned how to do all the rudimentary stuff, and you can operate at a higher level.
Why do you think there is such a big barrier to entry into private equity? Why can't an investor say, okay, today I'm going to go buy a company and we'll see how it goes?
Well, they could, but it's not that simple, right? It's not. If we're going to want to go back to the Delhi example, I think we can all do that, but you need to buy it well. That's a skill set, right? You also then need to do something with it, and the PE firms have set themselves up to do both. I think it's very few limited partners, the investors who've actually set themselves up. If you think about your typical pension fund, they have they have levels that you operate at. They have remuneration caps. They don't have value creation teams. They're not out there running a company on a daily basis. This is why they're the limited partners and not the general partners. They pay the general partners the fee and part of the carry to go and do that, and for that they set up and run exceptionally qualified teams.
So it's a high barrier to entry because it's not an easy transaction. That's what I'm getting from you is that it's not only are you taking on a very difficult transaction, but then you have to excel at it. The execution is where the money is. Finding the deal is easy. If you have money, you can do it. But if you want to succeed in this business, it's really about understanding the market, how to grow, who to sell it to after, liquidity events, getting cheaper capital. There's so many things that have to go right, and that you have to coordinate very strategically for it to be successful. Can you share a specific turning point, maybe a project or a challenge or even a failure that really changed the way you approached investing or leadership?
So from the investment point of view, that's kind of funny actually. I think setting up my own shop and having tried to raise capital there has been a bit of a game changer in terms of how I think about investing. Sort of having been on the receiving end of talking to venture capital firms in this case, you start thinking very differently about how they do and how you'd actually do due diligence. So it's been a bit of a game changer there. Otherwise, you'd find, which is probably good, that the large institutional investors, we pretty much do the same things. And it'd be really surprising if we did not very differently because we're all investing into the same black box. The fund has made no commitments. And so the due diligence we run, by and large, should be pretty identical. And then, sure, we all look for different little traits, but it should be somewhat equivalent. We look at the same KPIs, we look to do the same kind of analyses, we look at the same attribution type of things. We try to do the same reference calls. It's a fairly sort of, I wouldn't say straightforward process, but because it isn't, but it's standardized to some extent, if I can say that without offending anyone.
Why would anybody work with one or the other if it's standardized?
In terms of for one firm or another, well, it's more, the analysis we do, we look at, and each firm will break it down in different ways, but we look at the firm, we look at the strategy, we look at the track, we probably look at how they apply ESG in the firm, at least if we're European today. Some will look at comparable, funds, what are the terms and conditions. And so we go through all those things because we should all be able to tick those boxes and say, hey, this investment makes sense. If we then dive into the track record, we might look at returns slightly different. We might attribute to partners slightly different. And I think even if we do the same analyses, our conclusions may be different because it depends a little bit on what am I looking for if I'm institutional investor A, what are my investment guidelines compared to, what is investor B looking for and what is their investment guidelines. So they may end up saying no to a transaction that I say yes to, not because it's wrong or there's anything bad, but just because it doesn't really fit ultimately, or maybe they found a better opportunity or something third.
how would you how would you say differentiates those who excel to those who are normal, to those who are baseline?
From the investor side or from the GP side?
Both. Like,
Both.
as let's say I'm an investor, I want to choose a GP. Why should I? How can I filter a better GP that's going to be able to give me outsized returns?
First of all, you need a really wide funnel. I think a lot of private markets investors have become very reactive. We are truly overwhelmed now with people trying to beat our door in and getting capital out of us. And that makes it hard to sort of what's actually out there. And so if you're not continuously screening the market, if you're not set up for doing that, if you don't know pretty much all the growth funds in India, you're making a poorly informed investment decision. If you do know all of them, well, then you're making a better informed investment decision. But that is extremely laborious because the problem about private markets, and this again leads to Belentic, it's not that the transactions as such are private. Anybody with money can do that, and anybody with enough money can invest into funds. It's that the data is private. So without the data, we don't have a Morningstar, we don't have a Bloomberg. So screening the market is a very laborious, intense process, and very few LPs have the resources available to do that. Even some of the largest players in the world, they don't see even half of what's actually available. So the more you can sort of turn over and use your network to find out who's doing what, what's moving in the market, the more informed you are, the better investment decision you can make. And then of course you have to set yourself up to turn all the stones over. There's no brainer in here. You know, past performance does not equal future returns. That's a jumping off point. So with that, you now screen the market. You now have your analysis. And this is where I think it gets interesting for me, at least on an intellectual level. You now try to build a 10-year forward-looking investment hypothesis for why this manager, at a very minimum, should be a second quartile manager, but hopefully a first quartile manager. That's a tough assignment on any given day, but it's also an extremely interesting intellectual exercise if you want to dig into it. That was the first part of your question. What makes a great GP? The ability to buy something, well, below market price, buy it at a good price or even overpay because they have a good thesis, do something with it. So have a strong value creation team or, maybe some significant domain expertise where you can help the company grow and accelerate, grow the top line, control the cost lines, um, you know, maybe build it up more, all of these things. And then ultimately, the best managers, they plan for the exit when they do the entry. They plan multiple roads. They revisit the exit thesis every so often. They will have exit committees that look into challenging the investment team. Hey, maybe we should exit this. I know it's only a 1.5, but it's not going to go anywhere. Let's get rid of it. And let's focus on the one that can go from 2.5x to 3x instead. So again, sort of, extremely rigorous, very systematic. They have a playbook. They know what they're doing. Again, they also screen the market. They know everything that's out there. They're doing, God knows, widget manufacturing. They know every single widget manufacturer, in the mainland US. And they will screen that and look for which one is the best.
Super comprehensive of what both sides of the coin is, right? You said data is the hardest in private markets because you don't have a Bloomberg terminal for private markets. You have to call, you have to look, you have to be in the game, you have to talk to people, and you have to trust that data and then consolidate and aggregate and then analyze. And I'm sure that's where AI comes into play. The main problem about private markets, but then the GP side, I think is also critical of being able to do a good deal, structure multiple exit strategies, downside protect your investment. It's endless learning. I love it. That's why I think it's one of the best opportunities if someone is curious to learn about private equity because it's just endless learning. Every day you'll find something new. How has living in cities, you've lived in Hong Kong, Manila, Zurich, Copenhagen, like you've moved around. How has this international perspective shaped your view of capital and the opportunity or perhaps even risk?
Oh, that's another fabulous question. Now, I think the first thing I learned is that low taxes do not make you happy. I've had no taxes. I've had very low taxes, and I arguably sit in one of the highest taxable countries in the entire world right now. So that's maybe number one. Don't move for taxes. Move to a place you'd want to live and try out living. I've also seen what sort of unbridled capitalism does to societies. It's it makes you appreciate a country like Denmark where pretty much everybody's equal. We don't have a lot of poverty. Nobody's really left behind. There are downsides to Denmark as well, but you start appreciating it. How's it shaped my view of capital? I don't think I have a good answer for that. I don't think it's changed that much. I think we should all be a little bit better off, and I think capital markets can actually help that. I mean, I think one of the things we're really fortunate about in a country like Denmark is we do have a lot of security. We have large pension funds. Everybody's sort of taken care of in some way. Everybody's helped along. I think that's very important. It gives a lot of sense of safety, and certainly a lot of developing countries that I visited or lived in could certainly use some of that. I don't know if I answered your question, Ahmad. It's a really fabulous question.
I think you have actually. I love the tax, how taxes have become something like, oh, you should move somewhere because it's low tax, but you might not be happy there. And actually, I have a metaphor for taxes. Because I live in the States, I think the States is like, to me, being an international guy, moved to the States and they're like, but you're going to pay taxes. I'm like, yeah, but this is like being part of a country club. You have to pay the country club dues. It's just part of living. And then because I'm here, I have access to develop my business, which is private equity real estate, which is a little bit different than what you do. It's a little bit more simplified because I think private equity can be extremely complex. Something that I've had, I wanted to ask a professional, someone that's been 20 years in this business, how you deal with emotions. Because investing, I went to school for finance. This is what I do over 10 years. And then when I explain something to people, I'm like, look, we did our due diligence. We left no stone unturned. We structured the deal so that we have everything in place. All our ducks are in order. We're protected every single way. We've done it 100 times. And then people are like, I'm afraid. How do you manage emotions at that level of professional level, of institutional level? Is there any place where you're like, I feel doubt or I feel confident? How do you use that?
I think that there's always holes in the cheese. No matter how much due diligence you do, and you worked through it very nicely, right? And so you've done all your homework and you're sitting there now, do I push the button? Do I send 10, 15, 20, 30 million, 300 million to work? The more of the money that you own, I think that the more the emotion might actually go up. And so I think the best advice I've ever been given there is you need to look for reasons to invest because we can all find reasons not to invest. And the reasons not to invest are the ones you want to investigate as part of due diligence with the manager and say, hey, look, I don't understand this. How do I get comfort or how do I understand it? And if you can sort of cover them and then find what are the reasons to invest, I think you go beyond the emotional sort of where we all sort of feel a little bit, you know, uh, our stomach starts churning a little bit over. Hey, I'm about to put $30 million to work in this, and I'm not 100% convinced. But you'll never be 100% convinced. So if you can get over a certain level, and if you get comfortable on the yellow flags, there can't be red flags, but you've got a couple of yellow flags, so you're comfortable, and if you understand why they're there, and if you know that the manager understands why they're there, then you have your reasons why to invest, and off you go. And then there's a nice, I guess, get out of jail free card because most of us then go to an investment committee and we make a committee decision. We're all equally guilty or not, right? That certainly helps a little bit.
Yeah, I hear what you say, and we call our investment committee the committee of fear because we call it like, what are we afraid of? Are we afraid of a market downturn? Are we afraid of interest rates climbing? What should we be afraid of? And then plan accordingly, and then say what is plan B, plan C, plan D. But I've noticed that when you call it your investment committee, the committee of fear, it's so hard to then say, okay, let's push the button. But I like what you just mentioned is, find the reasons why you want to invest. What makes this deal better than the other? And it is a good day at the office to say no. Like this is something
Sure.
that maybe a lot of people don't realize about private equity is that we're not obliged to invest. We don't have to. Like we don't have to do anything. We only do when we are convinced that the hurdles are things that we can overcome. So
I, I,
but I liked your idea of like, let's find, okay, prepare, but then find the reasons why we do want to be part of this. And money isn't the reason. Perhaps for at least for us, it's not like, oh, we can make so much money. That's never the reason for us.
I don't think it should be. I would agree to that. You shouldn't forget the number. But the number is really only important in the context of what does it look like in my portfolio construction. I have had what's called the misfortune of sitting on one IC where they decided they didn't really like the investment, so they wanted to cut the commitment down by 50%. Well, this is very binary. If we don't like the investment, no amount of cutting it down or scaling it back is going to make it comfortable. You know, either you like it or you don't like it. If you like it, then you size the number to your portfolio. If you don't like it, that's a zero. We don't have to invest your point. There's no pressure on that. I mean, we can go on to the next one. And that goes also for the general partners further down the road, right? There's another deal that's going to be coming. And a lot of deals get struck out, and they should, because it should be hard. The hurdle should be high. And I think a good investment committee or committee of fear, I kind of like that, although it sets a very sort of harsh stage maybe. It should be perhaps a little antagonistic. It's okay to disagree verbally in that room. People don't have to agree. We don't need silver bullets either that somebody can just pick a deal and go with it. But it's okay to have, somebody knows more about the deal, somebody knows less, and it's okay to try to poke holes in it. And maybe you're not comfortable, then you vote no, and then it's a majority voting type of thing. And if you go with it, then we all leave the room and say, look, we hope it goes well, right? That's our job.
Yeah, and uh, and that's why I think investment committees should be private. I think you said you don't like the word democratization. I agree with you. I don't like it either. And investment committees and investment memos have to stay private as well, because that is a place where people can voice their concerns, and they can say this deal can go wrong, but that doesn't necessarily mean it will or it won't. And it's not for then, 3 years down the line, say, I told you so. This is not the point of the investment committee. So that's why I think many people don't understand the role of investment committee and why they are so private, and they don't like to. It needs to be a safe space so that you can make the right decision.
I agree. Also, especially if you're running third-party capital, so either you're the direct GP or you're a fund of funds, then your investors will start looking into it and saying, well, hey, guys, come on. Now we're working with about 60-60 hindsight. That doesn't work. We're going to be second guessing from ever after. So I agree with you that that is a private discussion amongst the principals who make that decision, and shouldn't be leaked. And there's nothing bad in it, but to your point, I mean, everybody will hold a little bit back if we all know, hey, we're going to pass this on to all our investors, and it might be leaked all over the internet. Well, I'm just going to, yeah, I'm going to be too rough on this. Also, you don't want to necessarily, in my case, as fund of funds, to get back to the GP, right? We're not saying nasty things, but we're saying things that we may not want to get back to them. We have a relationship, and we should be able to speak freely.
Absolutely. You've built Belentic to bring more intelligence and structure to this space. How did you start, or what's your value proposition, and how are you meeting that?
So the value prop is digitizing private markets. So we're gathering a lot of data that allows us to do digitization. So the value proposition really is just increasing efficiency. If you look, whether you're a GP, an LP, a consultant, a placement agent, whatever type of market participant you are, we operate in an extremely analog type of industry, almost anachronistic. And the reason we do is we don't have data on which to base decisions. So we cannot move at speed. We actually have to turn everything over. The most digitized we are Zoom calls, and that's arguably only because of COVID. And so it's really our value proposition is, look, we can make you faster, we can make you better, we can make it cheaper for you to do that. That's a pretty compelling value proposition, I think, because look, ultimately, at the end of the day, our first product, everybody wants more informed investment decisions. Everybody wants to do faster things or do things faster. Everybody wants fewer meetings, fewer chases, fewer phone calls. Nobody wants to drink 100 cups of coffee to pick up one check. I mean, that's just nobody. Nobody in the entire world, Ahmad, deserves to drink 100 cups of coffee to get a commitment from an institutional investor. That's too much coffee.
What are the biggest inefficiencies, or perhaps even blind spots that have how private markets operate today?
It's definitely the lack of digitization. Um, yeah, the managers are actually very good at digitizing their own companies, or sorry, their underlying companies. They're not necessarily very good at running or digitizing their own company or marketing or branding themselves. The same thing goes from the LPs on the other side. They haven't really digitized. I mean, we sit and we copy paste things from one Excel into another, and then we copy paste it over over into a Word document or a PowerPoint. Some are a bit more sophisticated, arguably, especially the large third-party managers. But we don't operate efficiently because we don't have to. There's a high margin business. It's a we can throw money at people and throw people at the problems, and we've done it. So we do need, and lots of people recognize this. iCapital over in the US, around in Europe, we got the likes of a Moonfair that's also working on these types of things. So lots of people are working on different bits and bobs. You've got people looking at digital onboarding. That's another huge hurdle, filling out subscription documents and getting onboarded into a fund. Uh, I'm not trying to take the job away from the lawyers, but I don't think the lawyers want to be filling out subscription docs either. They could probably also work at something that was a little bit more high margin. So definitely the most inefficiency just comes from the lack of the fact that we're analog. Everything is analog.
And it's crazy, 2025 still thinking that the most profitable, highest returning business model in the world is analog. So definitely a huge opportunity there. Let's go into like why you don't like the word democratization. Like, do you see individuals, founders, executives, high net worth, family offices stepping into this space? How is that changing how deals are done? And why do you think, or why don't you like that word? And how are these people, these more private capital, coming into the market, changing how things operate?
So I think democratization is a marketing word. It sounds really benign, and look, we want to help out everybody. If you really wanted to help out everybody, you should look at commoditization, because if it's commoditized, you can freely trade it. The cost of trading it is very, very low. Hey, then that's great. Then you actually also, by the way, democratize it because now everybody has access. So democratization is a nicer way of saying access for everybody. It's like, do we want to democratize car driving? Why shouldn't 2-year-olds be allowed to drive a car? We don't talk about democratization of driving cars, right? Why are we talking about democratizing an immensely complicated asset class? There's a reason why we, after the GFC, told all the banks and financial institutions at large, you cannot go out and sell highly complex financial products to anyone off the street. And democratization obviously sort of pushes in the other direction. So it's a marketing gimmick. I think we should try to commoditize it instead. I think we need to be very careful about pushing into the retail space where people don't necessarily fully understand. They don't understand the structures. They don't understand how the fees work. They don't understand how gating works. They have no idea what the actual cost of a fund actually may be, and they certainly cannot screen the market. And they will likely want to exit, at least if we look at how public markets function, they will likely want to exit at the worst possible time. So when the proverbial bleep hits the fan, they'll head for the exits, and that's the worst possible time to start selling your private market stuff. So why do you want to push it down to these guys? Let them come through vehicles. Then there's the second part of your question: how is the wealth channel, if we can call it that, high net worth individual, family office, on changing it? There's a lot more money coming in. They want to do co-investments. Many of them are actually more sophisticated than they're given credit for. Lots of the family offices, gone through generations and systems as well. People have MBAs and maybe even private equity themselves. So as they tap more into the wealth channel, we're getting a different type of investors, maybe a little bit more hands-on some things, maybe a little bit less focused on due diligence in other cases, but for better or for worse. What will also, I think, really change things there, the more we push into the wealth and retail channels, the more the regulator is going to get out a big flashlight, and they already have started, and start shining it on an otherwise opaque world, and they're going to start tightening regulations. And that's not necessarily a problem, but where the challenge is, they're going to tighten the regulations for everybody. So where the largest firms in the world can probably handle that, this becomes a burden now for the smaller mid-market managers, the small cap managers, who don't have the resources to do this and who are not tapping into the retail space. So some things happening there, and arguably also you lose some of the flexibility. I mean, we're already seeing some of that you can't do certain things. You've got retail money in there and these types of things. So it's again, we're back at it's such an interesting industry. It's going to change so much over the next 1, 2, 3, 5 years, 10 years. not just liquid vehicles and retail and so on, but things we haven't even thought of yet because we got an awful lot of smart people in there thinking every day about what if we did this? Would this work?
You're absolutely right with the word democratization. It's a commodity, but then again, the commodity shouldn't be open to everyone because I actually think regulation wasn't built because bad actors. I think it was built by big players and lawyers to make it more expensive so that less people can come into the market. But that also it makes it more inaccessible, and then fees have to go up, and then people are like, why are fees so high? And then the only ones that can go have fee compression are the big guys. So it's like, it's a vicious cycle. It's a very difficult chicken and egg, or perhaps checks and balances situation where like how much regulation is too much regulation? And then how do you make this more accessible for more private capital or that wealth channel to come in? I do think that the only part it's just my opinion, is that private capital is more flexible. It can be more strategic, and perhaps it could be built for the less check the box. It's more for the Frankensteins, the one that have like a real estate component with a private equity component with an operational component that then has to do these Frankensteins that institutions are like, come on, I can't get comfortable with this, but a family office or perhaps more private capital might be more behind this. You're at the intersection of private equity, AI, innovation, and you started to talk about it a little bit before. What do you think is going to happen in the next 3 to 5 years?
Well, we're going to see AI agents. I think that's one of the things that's going to happen. The real challenge again here is it's not that we don't have data, it's that we don't have high quality data freely available. And if we go off all these big databases we can buy, you're going to get a lot of spurious answers because the data quality is very low. But we're certainly going to see, I think, people trying to build AI agents within private equity. Go find me three great funds that I kind of invest in, that kind of thing. Please fill out the subscription docs for me. Here are my details, and here are my banking details. Start transferring the money, type of thing. Maybe, I don't know, but we're gonna start seeing that. That will creep in here as it creeps into every other industry, and that's, I think, the cutting edge. I don't think there's a race on to build it yet. It's very early days for us, and as I said, the main challenge for us is how do we get good data. So you take your individual manager has extremely high quality data on their own portfolios, and many have already started implementing it there and also helping their portfolio companies with this. So we'll see an acceleration there, I think. On the investor level, I think it's a bit harder because even the largest multi-managers in the world haven't invested in a lot. So how can you use AI if you don't see the whole universe? It's a good question, right? But I don't have a good answer for that. We're working on Balentic to get more data to be able to do that. But that is the prerequisite. We need high quality data, and we need to cover a large part of the universe. Otherwise, it makes no sense. We have an AI agent for buying cars, but we only have data on BMW. The answer is always going to be buy a BMW. Strangely enough.
Yeah. How do you think it's going to change the way that we source or perhaps diligence or maybe execute deals once because I actually have a theory that there are already AI agents. Like I would bet a BMW that Blackstone is using agents already. Like they're not, I think they're ahead of the curve. They're just not telling anybody. How do you think that's going to change in the future? The way do you think it's going to help us perform better? Or is it just going to be like, oh, we don't have to hire as many analysts anymore?
I think it's a combination. I do think it'll increase the efficiency, which means we're also, if you look at the GP level, if they can screen the market much more effectively using AI agents, they're in a vertical heavy in industrials, and they can use AI agents for that, good data sets, and run the analysis, possibly build the models, build the investment thesis. Well, then, the senior analyst can, do a lot of it and screen it and, edit the proposal. You need fewer bright sparks around. So I definitely think that's part of it. So yeah, fewer people, more efficiency, some cost savings. I think all the managers can see the benefit of that. It's we're gonna see the lowest performers get cut a little bit quicker. I think you're not gonna get rid of analysts altogether or associates altogether or mid levels altogether. but fewer people can do more things because they're using AI. We already see it in other industries. I think so. Um, I think ultimately, again, we're back at you can screen the market much more effectively. You can turn over more stones. That should give you more insights. It should you're at least making a more informed investment decision. Will more informed investment decisions lead to better outcomes? I'd argue yes, but we're going to have to wait and see. And it's the same thing if you look on the investor side. If we can have AI, and we can arguably already do that even without an agent, we can have an AI actually write the investment thesis for us. We can upload all our old investment theses. We can train the data on that. And then we can say, hey, write an investment thesis on this fund. And then the analyst edits it through. But instead of spending 2, 3, 4, 5 working days or even more writing it, the AI writes it for you and you edit it through over a day or two. You sanity check it and you're off to the races. So also there they go. So more efficient. Will they have a better outcome? I think so, because they can now effectively screen many more funds if they can get the data. So if they can get the data, they can screen many more funds more effectively, better informed investment decisions. And again, I'd argue if you're making better informed investment decisions while trying to do that right, that should lead to superior outcomes.
Yeah. Yeah. If someone is building wealth today and wants to future proof it, what kinds of investments or strategies should they be learning about?
That's another really fabulous question. I don't think there's a simple answer to that, and I don't think I'm the best person in the room to answer it, because this sort of falls into the, how do I construct my portfolio at an asset class level? I think so. I can sort of high level think through it. How much fixed income do you want? How much public equities do you want? How much alts do you want? How do you want the different proportions? I think if you're trying to think about your investment strategy, you need to take it from the top and then work down. And who knows, maybe you end up with, depending on your level of wealth, saying, hey, look, for my private equity portfolio, I'm just going to find a nice big fund of funds and maybe do a couple of fund picks on things I really like, and that's it, and simplified. I think there's a lot of people, because it's much more interesting to work down in the engine room. They do it bottom up. So they start with the fund selection and start of where I work. It's always portfolio construction drives the choice of the funds. You find in some shops at least that the analyst drives the choice of the funds, and that's kind of what ends up in portfolio construction. Again, the outcome may not be bad, but I think you're better off starting with what do I want my portfolio to look like? How do I want my risk return to look? But for this one, Ahmad, I think you'd find some people who are much more qualified to give you a really insightful answer on that than me. I'm a sort of one trick pony on the private equity, private market side.
I disagree. I think your 20-year experience, multi-country, you've seen a lot and definitely opened our eyes and my eyes of, the power of private equity and how big it is and how, the big problem there exists, that it's still an analog system. That as it becomes digitalized, more opportunities will appear, more things can be done. And the ultimate question is, will that drive returns up or will it stay the same? Cost will come down. We don't know. This is something that we'll find out later. But I think it's been wonderful to have you here and understand more about private equity, but also very excited of what you're building, because I think that knowledge has always been power and education has built people to think a little bit differently. So I want to finish the podcast by asking you what's next on your horizon, what personally or maybe personally or professionally, is there something that is that's pulling you forward right now?
So on the personal side, I've got a 2.5-year-old and a 5-year-old. They tend to keep my hands full, and that's the other day job that I have, is the little family, and that's arguably the most important part of my life. Yeah, without sounding too grand, I like to make a dent in the industry. I think we could be better. I think we're really onto something in Valentic, and I think that's a huge driver. That's a huge motivation. It's a lot of fun. We get the feedback we get from our customers is usually extremely positive, and that's another big driver. And so that makes it more fun. So it's you know we can be better, and it's an industry that strives to be better. So that's fantastic to work with, and so that's a huge motivation every day that I go to work. That, and I'd say running your own company, there's a lot of learning, but that's usually fun as well, right? There's also a lot of frustrations, but man, we can do a lot of stuff that we were never allowed to do in the firms I sat in before. And it's not, we're not doing illegal stuff. It's just our hands are not tied. We can install software. We can use Chat GPT. We're obviously mindful of how we use it for these types of things. So that was not a very concise answer, but it's opportunity to make a dent, to make an impact into the industry.
For
That's a
sure.
major driver for me.
Yeah, yeah. Definitely see eye to eye with you on building your own company, and very excited to see what you can turn your company into. For me, you have a reader. I love the blogs. I think what you're doing
Thank
is
you.
very interesting. So I will link all of them below. And is there any way that you would like people to contact you, or I will put all your contact details on the description so that they can reach out if they have any questions.
Feel free to do the latter. Happy to connect on LinkedIn. We're always available.
Thank you, Casper, again.
Thank you, Ahmad. Thanks for having me. Great questions. Really appreciate it.
Of course. Welcome again in 5 years. I want to see what you did.
Yeah, let me know, and we'll see if AI outperform the humans.
Thank you.
Fantastic. Bye, Ahmad.